Hello and welcome to the second part of today's webinar series. In this webinar, we'll be looking at IAS 37 provisions, contingent liabilities, and contingent assets related questions. Okay, again, the format is the same. You'll be asked to have a go at the questions by pausing the video. You should then resume the video to actually compare your answer with the model answer and see whether you're right or not. Okay, towards the end, we'll identify the questions which you are supposed to be doing as homework. Let's start. So the document you're looking for this webinar is called IAS 37 and 10 seminar questions. We are not looking at IAS 10 in this video session, just looking at IAS 37 related questions. And those are first four questions in the document. Question 1, 2, 3, and 4. That's correct. Yeah. So please go to Moodle and fetch that document first. Return to the video later. Okay, so now if you have had a chance to get the document, let's start looking at the questions. There are some questions on recognition of provision and there are some questions on the measurement of the provision. Okay, so we are going to be looking at the recognition criteria first. Starting with question 1 and looking at the requirement, we have to determine whether we can recognize a provision in statement of financial position or not. The key word over here, or the question verb, is recognition. So we need to apply the recognition criteria of IAS 37. If you remember them, okay, they are: first, it needs to meet the definition of liability, again, which is the present obligation due to past events. So that's criteria number 1. Number 2 is that there should be a probable outflow of economic benefits. Okay, so it should be more likely than not that we will have to pay some sort of money in future or economic benefits of sorts. And number 3 is that the cost of that provision must be measured reliably. Okay, if those 3 criteria are met, then we can recognize the provision. So let's have a look at this question. A manufacturer gives warranties at the time of sale to purchasers of its product. Under the terms of the contract for sale, the manufacturer undertakes to make good by repair or replacement manufacturing defects that become apparent within 3 years from the date of sale. Okay, on the past experience, it is probable, more likely than not, that there will be some claims under the warranties. Okay, now we need to determine whether there is a present obligation in this scenario, and the obligation could be either legal obligation where they are legally bound, there is some sort of contract involved, the company is liable to do that. Okay, or it could be a constructive obligation where the company has actually made it clear by their practice in the past or by making a promise, okay, that they will carry out such and such expenditure in future, in which case there is a constructive obligation. So you need to determine what kind of obligation there is, if there is one. Okay, will there be a probable outflow of economic benefits, and assuming that the cost can be measured reliably based on their previous experience, whether we can recognize a provision or not. Let's spend 5 minutes on this question, return back to the video, and then we'll look at the answer together. Okay, now if you have had a chance to look at the question, because it's a kind of a written answer, okay, we need to, if you remember the steps that we discussed in the previous seminar as to how to tackle this kind of application based questions, the first thing we need to do is to state the knowledge, and in this case the knowledge is about the recognition of provision. So let's start with that. So according to IAS 37, a provision is recognized if and only if that there is a present obligation as a result of past event, okay, and there is an outflow of economic benefits, okay, which is probable, and the cost is measured reliably. So these are the 3 criteria. Knowledge part done. Now we can apply it to the scenario. So what can we say? In this scenario, or in the above scenario, what is the obligating event here? The obligating event is actually sale of the item with this kind of warranty. So the obligating event is the sale of product with a warranty, which gives rise to a legal obligation, right? So the first criteria is met. The second is about probability of outflow of economic benefits. The past practice of the business suggests that it is more likely than not that there will be claims and the company will have to pay the money or repair the products. Outflow or return, accept the returns. Outflow of economic benefits is probable for the warranty as a whole, based on the past experience. And therefore, if we can measure the cost reliably, okay, which is quite possible, we need to apply probability and outcome uh, valuation calculation over here, which we'll see in a minute. But if we can work out the cost of the probable outflow of economic benefits, we can actually recognize the provision. So the provision is recognized for the best estimate, okay, of the cost of making good under the warranty products and before the balance sheet date. Okay, so we need to work out the cost, and if we can do that, the provision is recognized. Okay, so the key over here, whether there is a present obligation, whether there is a probable outflow of economic benefits, and lastly, if there is a cost which can be measured reliably. All right, simple. Now, have a go at question 2 as well. Oops, sorry. Let's have a look at question 2. Again, same kind of criteria, requirement. Should a provision be recognized in the statement of financial position? Okay, an entity in the oil industry causes contamination but cleans up only when required to do so under the laws of particular country in which it operates. All right, so unless there is a kind of legal requirement, they are not going to clean up. One country in which it operates has had no legislation requiring cleanup yet, and the entity has been contaminating land that the country in that country for several years. On 31st December 2006, it is virtually certain, on 31st December X6, it is virtually certain that the draft law requiring cleanup of the land already contaminated will be enacted shortly after the year end. Okay, now we need to determine on 31st December X6 whether there was any present obligation to do so, the cleaning up. If so, the provision will be recognized. Have a go. 5 minutes, return back. Okay, now this time I'm not going to prepare the full answer. Okay, I demonstrated that how to write. Okay, so we are going to take a kind of a shortcut, but in the exam you need to write in full, but this should be the key points in your discussion. So let's have a look. This is question 2, starting with the first criteria, present obligation. The obligating event is the contamination of the land, right? Which is the past event, which gives rise to a present obligation because of the virtual certainty of the legislation requiring the cleanup, which actually makes the outflow of economic benefits probable, okay? And therefore, the provision is recognized at the best estimate at 31st December 2006. If we can work out how much it is going to cost us, we are going to recognize the provision. Okay, similar kind of criteria. You just need to remember the recognition criteria. It becomes very simple afterwards. The third question is about recognition again. Okay, so let's have a look. In November 2005, a new legislation was announced which requires companies to fit smoke filters to its factories by 30th June X6. Hasn't happened yet, but it's next year. After 30th June, the factories without smoke filters will have to pay a fine. Nyasa company, which is in the question, has not fitted smoke filters yet. Should a provision be recognized in the statement of financial position for the smoke filters and fines if they don't fit them at the date of financial position when they are prepared on 31st December X5? Okay, again 5 minutes. See how it is different from the previous example. Okay, if so, and if there are differences, talk about those differences. Identify whether there is a provision or not. Identify whether there is a present obligation or not, and that will help you determine whether there should be a provision or not. Right. So how is this scenario different from the previous one? In the previous case, okay, the obligating event, the past event, had already happened. We have already been contaminating the land, and that actually would trigger the present obligation to clean up the land. In this case, the legislation hasn't come into the force yet. Okay, it was announced, but it will require a company to start fitting the smoke filters from next year end, not this year. So this year we are not actually presently obliged to do so. Okay. Therefore, there is no present obligation. There has to be a present obligation. So what we can say is that there is no obligation because there is no obligating event yet, either for the cost of fitting smoke filters or for the fines under legislation. All right. The legislation doesn't require the company to fit the smoke filters by this year end. Okay. Therefore, we cannot actually recognize either the cost of smoke filters as provision. Okay. Neither can we recognize the cost of fines as the provision. Does that make sense? So the key difference over here is that in the first scenario, the past event had already happened, okay, which is actually where we have started contaminating the land, okay, and there will not be any way out from that, um, other than actually accepting the obligation and carrying out the cleanup of the land. In this case, it is possible to avoid the obligation altogether, okay, by next year end. And the way it can do it, it may sound silly, but the company, if there is a trial chance to actually avoid the obligation, you can't recognize the provision. What can the company do in this case? Well, they can maybe shut down the entire business or that operation to avoid the implications of not fitting the smoke filters. So there is a way out. There is no present obligation currently. Okay. If there is obligation to do so, then we recognize the provision. So if there is a slightest chance to avoid that obligation, we can't recognize the provision. Okay. Question 4 is about measurement now. Okay. So let's have a look at the question 4, measurement, where there are multiple outcomes. Okay. In this case, we are required to calculate the amount of provision to be included in the financial statements and show relevant journal entries. Fair enough. An entity sells goods with the warranty under which customers are covered for the cost of repairs of any manufacturing defects that become apparent within the first 6 months. Sounds similar, doesn't it? It's similar to the first question. If minor defects were detected in all products, repair costs will be 1 million. If major defects were identified, then the cost will be 4 million. So imagine if all the products come back with minor defects, it's going to cost the company 1 million pounds. If all the products come back with major defects, it's going to cost the company 4 million. The entity's past experience suggests that for the coming year, 75% of the goods sold will have no defects. There will not be any defects in the 75% of the goods. 20% of the goods sold will have minor defects, and 5% goods will have major defects. Okay, so what we need to do here is apply sigma px approach, where we are going to multiply the probability of the outcome with the outcome. So for example, the probability of goods coming back with minor defects is 20%. Okay, probability of goods coming back with major defects is 5%, and probability of goods having no defects at all is 75%. Okay, so we will have to multiply this probability of 20% with the cost of repairing minor defects if all the products come back with minor defects. So that will be 20% multiplied by 1 million, 5% multiplied by 4 million, and 75% multiplied by 0. That should give us the total value of probable cash outflow that will be incurring in future in terms of repairing the goods. Provision brought forward from last year is 380,000. What we need to do is calculate the amount of the provision to be included in the financial statements, and we need to show the journal entries. Slightly bigger question. I'll give you around 7 to 10 minutes to tackle the question. Return back, we'll look at the answer together. Okay, so let's have a look at the answer and let's prepare it in an Excel. Okay, slightly less, make it bigger. So first of all, we need to work out the, oops, what's this? we need to work out what the year-end provision will be. Okay, so for that we need, say, working. We'll call it working one, and the working one will be probability into the outcome. Okay, so that's, if we lay it out in this form, so in the first column defects, second is the probability, we call it P, third is outcome, we call it X, and the last column will be multiplication of probability with outcome. Okay, so let's start with no defects. Okay, and that's 75%. Okay, outcome will be let's work in millions over here. Yeah, so that's millions. It's in dollars or pounds? It's pounds, sorry, it's in pounds. And last one is sigma px. So we don't have to spend any money if there are no defects, and therefore px will be 0. If there are minor defects, okay, and the chances of goods having minor defects is 20%. Outcome in this case is going to be will be 1 million. Yeah, so that is 0.2 if you're working in millions. Yeah, should we work in millions? Let's work in millions. So 0.2. Okay, major defects, okay, which is going to be 5%. Yeah, 5% into 4 million. Okay, which is again going to be 0.2. Okay, and the total here is 0.4, or in other words, it's going to be 400,000 pounds. Okay, 400,000 pounds. This is going to be in millions as well. So millions. Okay, so now working 2 is actually to work out what the year-end provision is going to be. We have been given the opening balance of the provision, which is 380,000. We can compare the two figures and find out whether it is increase or decrease, just like bad debt provision you have dealt with before. Okay, so let's say this is the provision brought forward. Okay, provision opening balance brought forward. We wrap it. There you go, and it's going to be 380,000. Okay, and then if we leave one line and then we say provision carried forward or closing balance, okay, again wrap it, that is how much? 400,000 we say. Yeah, okay, oops, I didn't leave one line, did I? So let's leave one line here, and that will give us the change. So opening was 380, closing is 400, so our provision went up by 20,000. Okay, and we call it increase in provision, okay, or warranty provision. Okay, account for it, accounting for it, let's have a look. So we can do the double entry, so I can show you the extracts. So let's do the extracts first. So this is statement of profit or loss. Okay, we are not working in millions here, just pounds. Same for the statement, pounds. Statement of profit or loss extract, operating expenses. Under that we are going to record this 20,000. Okay, so debit statement of profit or loss with warranty cost of 20,000 or increase in provision. Let's make it clear, that's increase in warranty W provision. Okay, right, so that statement of profit or loss. What about statement of financial position? The statement of financial position will go up as well. It was previously, by the way, it is recorded under current liabilities because all those defects will need to be repaired in the following year. Warranty provision, and it's going to be How much? We have done the calculation. Opening was 380. We worked out that the closing is going to be 400,000, and that's our closing, 400,000. Okay, that's really it. Okay, I'm just going to get rid of the formats here. It doesn't look very good. Clear formats. That's it, done. Okay, this is how it is. So the provision can be recognized. All right, we know that when there is a present obligation, either legal or constructive. In this case, question 4, there was a legal obligation of working on the defects of the products and fixing them. There is a probability of future outflow. The past practice suggests, again in example of question 4, that the company usually gets products with minor defects that represent around 20% of the population. Products with major defects represent around 5% of the population. So they are likely to repair them, okay, in future. That will cost them £400,000 next year. Last year's provision was 380,000 brought forward. This year's provision is going to be 400,000. So actually, from our accounting point of view, it is going up by 20,000. Debit statement of profit or loss by 20,000 and liability by 400,000. If this was the first time they're recognizing the provision, right, then there won't be any kind of increase or decrease. It's the first time. So the entire 400,000 in that scenario will be debited to statement of profit or loss, and the same amount will be credited as a liability. And then as the years progress, then we just charge statement of profit or loss with the increase or decrease in the provision. So say for example, in the following year, if the closing provision value becomes £350,000, then there will be a decrease in the provision, okay, £50,000, and that will be recorded as an income or a gain in the statement of profit or loss. Make sense? Good. So remember the definition of provision, remember the recognition rules, remember the measurement rules. Good. And the homework that you should be doing are question 1 to 7, okay, for provisions from the book. And please bring your answers to the next seminar question. I hope you enjoyed it, and all the very best. Thank you.